This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Chapter 13, Construction Contracts. This does come up as question 4 or question 5, and occasionally it comes up within question 2. Only as a little element of question 2, but the client was prepared, this is trial balance, and you have to prepare the financial statements, is involved in a construction contract. And Steve Scott will give you the detail of where we're up to with the construction contract. And with reference to construction contracts, if you imagine building a tunnel between England and France, or building a bridge across your river, the Southern Bridge, if you imagine that, the length of time that it takes means that it's likely that the contract will spread over more than one accounting year end. Some will be done in 2009, some in 2010, maybe even to 2011. So there are in fact 3 accounting, or 4, or in the case of the tunnel between England and France, I think there were 15 years it took to build that tunnel. So there are 15 or 16 different accounting periods which are affected. All the time that the construction engineers are working and the construction company is working on the tunnel or the bridge, all that time they're actually earning profit. But on the basis of being prudent, we wouldn't recognise the profit until the job was complete. So in a 5-year contract, I earn no profit, no profit, no profit, no profit, and then an enormous profit in the 5th year. Well, clearly that's not acceptable. Again, it's not comparable. There's no comparability between the first 4 years and the last year. So the IAS on construction contracts said, as you are doing the work, you will acknowledge that you are making profits as a result of the work that you have done. We can put it into the context of auditing, that audit firms will appear in many of your premises and new auditors will appear in many of the client's premises around this time of year, around October, November, December, to do the interim audit work ready so that you can go back again in January, February, March to do the final audit work on the final draft set of financial statements. So you've done some work in October as part of the audit for December 2011, then you go back again in February to complete the audit for December 2011. But that's a one contract exercise. And if your audit year end, if your audit firm year end is December, then I've earned some profits in the interim audit, and I earned some profits in the final audit. It doesn't make sense to say, let's not recognise any profits from the interim audit, let's defer them all until we've completed the whole job. So it's a question of matching. I incur the expense of paying my staff, the auditors, I incur that expense of paying them, and then I charge that rate out to the client. Well, I should be recognising the difference between the cost of paying my staff and the charge-out rate. That's the profit element, and that would be recognised in both 2011 and next year in 2012 when I complete the audit. That's the same principle as construction contracts, that as work is in progress, profits are being made. So on page 69, prudence dictates no recognition of profit until it's actually realised. But this is going to lead to major distortion. The IAS therefore requires us to spread the profit. The 4th bullet point, a construction contract, is a contract specifically negotiated for the construction of an asset, a bridge, a tunnel, a dam, a block of flats, a housing estate, a nuclear power station, a drilling platform. If it's going to take longer than the next year end, then it's going to straddle. You know the word straddle? It's going to straddle more than one year end. We're going to go up to 31st December 2011, and then we've got the year to 31st December 2012. And if we do some work there, we straddle that year end. Straddle is what you do when you sit on a horse you straddle the horse. You put one leg either side of the horse, and that's called straddling. So we're straddling more than one accounting period. We've got straddling at least one accounting year end. The construction contract needn't be one which is 12 months more or more than 12 months long. Again, with this situation, with the example of the audit, the audit may only take 5 months from start to finish, and even then, the actual length of time working on the audit may only be 3 or 4 weeks. So you do 2 weeks in October and another 2 weeks in February the following year, but we're straddling that year, and it does not have to be a contract which takes longer than 12 months. Some audits will take 5 months. Some audits could take 11 months. We do some work in January and we finish it in November, but it doesn't straddle a year end. So all the profit earned on that audit will be attributable to this year. But if we cross over that year end, then we need to allocate the profits. And same with the construction contract. If the building of the apartment block lasts longer than the next accounting year end, then we need to allocate the profits. There are two types of contract. There's a fixed price contract and a cost plus contract. A fixed price contract is where we negotiate with the customer, with the client, and say, yes, we will build a bridge for you and this is how much it will cost. And that's the fixed price. I've never understood the alternative, which is the cost plus contract. This is when I negotiate with you, a customer, a client, and I say, I will charge you a profit element of 10% on everything that I spend on your contract. I never understood why anyone would do that, why any customer would enter into that contract. Because not only do I not have any incentive to be efficient and economic, on the contrary, I have every incentive not to be economic. The more I spend, the more profits I get. So I've never understood the concept of a cost plus contract, unless there were a ceiling imposed on the contract. So everything I spend, I will invoice onto you at cost plus 10% with a maximum of 5 million. But otherwise, if there's no ceiling, I just don't understand why anyone would do it. There was a situation relatively recently when the Welsh Assembly was being built in Cardiff. And the estimate for the job was millions and millions and millions. And of course the buying officer, the purchasing, procuring officer, needs to approve invoices to say, yes, that's okay, yes, that one, and authorise the invoices. But you can't expect a buying officer to approve every invoice. Surely there's got to be some sort of de minimis provision, a layer, a level of expense where, yes, okay, it's not even worth looking at. Yes, I'll approve it if it's less than, and the situation there, I believe, was £10,000. If an invoice arrives and it's for less than £10,000, you're not going to get the person to sit there and authorise it for a screwdriver or 3 cartons of milk or 5 bags of cement. You can't expect a purchasing officer to do it. And I think I'm right in saying that the de minimis, the level below which the approval was not necessary, was £10,000 per invoice. And the newspapers got hold of a copy of an invoice for £8,000, which therefore was not approved. And it was for 1 screwdriver. The supplier knew about this de minimis authority level, and he invoiced a screwdriver at £8,000. It's less than 10, I'm not even going to look at it. Incredible. But that's what can happen when things like materiality levels are set, and the supplier knows about those materiality levels, then it means that the situation can be abused. One contract, I'm down towards the bottom of 69, one contract, multiple units. Separate proposals, and they will be treated therefore as separate contracts if there are separate proposals for each one. And I've given an example there in the third sub-bullet point. One contract to build 4 power stations. We can clearly identify the costs allocated to each of the power stations. We know which workers have been working for how many hours on which power station. We can allocate the costs of the raw materials that would be necessary to buy to build the power station. So if we have a single contract with the government, say, to build 4 power stations, then we would treat it as 4 separate contracts, 4 separate jobs. On the other hand, a group of contracts, but we'll treat them as one, where the contracts are negotiated as a single package. I will build for you, I've given the example, 50 separate houses on a housing estate. Each one of them looks like it's a separate contract. But the difficulties of allocating expenses in a situation like that would be so great that we would actually treat these 50 separate contracts as being just one. While I'm employing workers to dig foundations, and then a different group of workers to put the concrete in the foundations, the diggers are not sitting there waiting until the house is complete before they dig the next lot. So it's a sort of moving train of workforce. They'll be digging the foundations and then they'll move on and dig the next foundations while the bricklayers move in, or the concrete layers move into the first one. Then the diggers will move on to the third, and the concrete layers will come to the second, and the bricklayers will go to the first one. And so we've got this steady stream of skilled workers, and the difficulties of allocating costs and time, it's a continuous package. The electricians may be working on house number 37, and somebody then calls them back. There's a fault in the electrical wiring of house number 23. So they're moving from one house to another, and the difficulties of allocation are so great that we would treat it as a single contract. But you're not going to be faced with that in the exam. Probably. Page 70, contract revenue. Is the initial amount of revenue as agreed in the contract, together with agreed variations. Again, with an audit, for instance, if you've agreed by tender, you've submitted a tender to the client, and the client has agreed the audit's going to cost, say, $10,000. If you then come across a particular situation at the client which requires additional work which you had not anticipated, and it's not your fault, then you'd sit down with the client and agree an additional variation, a variation in the agreed price. We're now going to have to spend a lot longer than we had anticipated because of the faults in your system. We had not anticipated those, so we will need to do this extra additional work, and we're going to charge you an additional fee. So agreed variations in the contract price are part of contract revenue. But only to the extent that revenue will probably result, and these revenues are capable of reliable measurement. We've got an example there of Thomas and Yvette. Thomas has been asked by Yvette to build an apartment block in Kaunas. The project's going to take 4 years, and Yvette has agreed to pay the following: $1 million for the apartment block, an additional $300,000 if the block is at least 60% complete by the end of year 2, and a bonus of $100,000 if she's pleased with the finished block. Tell me, Yvette, are you pleased with the finished block? No. So I'm thinking that the likelihood of that bonus is pretty remote. We're not likely to get the bonus. But here we go. At the end of year 1, how much of total contract revenue should be recognized? In our revenue line in our income statement, we should be increasing the revenue, not just from the sales that we've made, but also because of this revenue that we have earned on part completing this contract in Kaunas. Well, the answer to this is not a definitive one. For instance, we may only be, say, 12% complete by the end of year 1. Or we could be 35% by the end of year 1. We could be 52% by the end of year 1. Or we could even be 63% by the end of year 1. So it depends on the stage reached, how far we have progressed with the contract, will determine the extent of the revenue that we recognise. The 63% is relatively straightforward. It will be 63% of the million, plus it will be 100% of the 300,000. We have, by completing 63% by the end of year one, we clearly have earned the 300,000 additional, the extra bit, if it's at least 60% complete by the end of year two. So we will have earned that 300,000. So we would recognise as revenue 930,000. 63% of the million, plus the whole of the 300,000. But what if we're 52% complete? What if we're here? 52% complete. It looks reasonable to me to assume that we're going to be, if we've done 52% in 1 year, surely we're going to be able to manage the additional 8% by the end of the next year. Well, prudence would say no. Don't take any of this 300,000 until it's absolutely certain. That's the bonus. What happens if there's strikes, bad weather, shortages of supplies that we can't find alternative suppliers for? Shortages of workforce, outbreak of war, force majeure, all sorts of reasons why we may not be able to complete that additional 8%. And so you take, in this situation, you take 52% of the million. And probably not anticipate any of the 300,000. So revenue would be 520,000. Same with this 35%. That will be 35% of the million. But what about the 12? There is a principle within the IAS that no profits should be recognised until the contract is sufficiently progressed that the outcome can be determined with reasonable certainty. No profit should be recognised until we sufficiently progress through the contract that we are able to predict with reasonable certainty the ultimate outcome. No profit shall be recognised. And I emphasize profit because I'm going to come back to this situation. No profit should be recognised until the contract is sufficiently progressed to be able to predict with reasonable certainty of the ultimate outcome. In an exam situation, Steve Scott will tell you, he'll say the directors have adopted an accounting policy not to recognise profits until contracts are at least 25% complete. So he will guide you. It's not up to you to determine, is it available to the directors to predict with reasonable certainty the ultimate outcome. Steve Scott will tell you what the accounting policy is. So in this situation of 12% complete, how much revenue will we recognise? 120,000 is what you said. Yeah. 120,000. We would recognise 12% of the contract value. 120,000 will be the revenue. But no profit should be recognised until we're sufficiently complete. So we'd have 120 in revenue, but would also have 120 in costs. So no profit is recognised. Revenue should be spread across the life of the contract, should reflect the extent of the work carried out. But no profit shall be recognised until the contract is sufficiently progressed to be able to determine with reasonable certainty the ultimate outcome. So in this context of Thomas and Iveta, we will be recognising 120,000, 12% of the 1 million. What about at the end of year 2? At the end of year 2, this 300,000 now becomes a certainty. And again, we've got the variety of situations. At the end of year 2, we may be, for instance, 38% complete, 59% complete, 68, 70, 100 complete. But we are now able to say, certainly, again, that we're 68% complete, and therefore we're 680,000 plus definitely the 300,000. But not the 100 if Iveta is pleased with the finished block. I don't think there's any certainty in that. And you, all you Ivetas out there, you Ivetas will also probably have determined now that you're not going to be pleased with the finished building. 59%, 590,000 will be recognised as revenue, but not the 300 because we didn't hit the target. Again, 38%, 380,000. But we've got a little bit of a problem here, and that is if I just go back up to year 1, I was 52% complete at the end of year 1, and then because things slowed down, I'm only now 59% complete. So up there I recognised 520,000. In year 2 I'm recognising 590,000. That gives me 1110 million revenue recognition. Don't write this down. That gives me 1,110,000 revenue recognition. But it's only $1 million contract. And I'm only at the end of year 2. If at the end of year 3 I'm 75% complete, and at the end of year 4 I complete the contract, then in fact I'm going to be recognising 2,860 million over the 4 years. This is clearly nonsense. This is clearly stupid. So when I'm calculating the revenue to be recognised, it's a comparative exercise. I had recognised 520 by the end of year 1. Cumulatively, by the end of year 2, I want to have recognised 590. So it's only the difference which will be recognised as revenue in year 2. I did recognise 520 in year 1. I'm now up to 59% complete, 590,000, and therefore it's only the difference between year 1 and year 2 cumulative revenue recognition which will go in the year 2 financial statements. I'll show you some workings in a minute which will hopefully make it easier, or make it relatively easy. Page 71, contract costs. These are costs which are directly related to the contract and costs which are generally attributable to contract activity and which can be allocated to the contract. So there needs to be clearly allocable or allocatable costs allocated to each separate contract. As such, other costs specifically chargeable to the customer under the terms of the contract. If I buy plant specifically to work on that contract and the plant can't be used for another contract later on, there's a classic example of that, of buying plant which can only be used on the contract. If that's the south coast of England and that's the north coast of France, then the tunnel was built, and they built the tunnel, and the English dug that way, and the French dug this way. But in this big machine, this big drilling machine that they had, no one had anticipated having a reverse gear. There was no reverse gear on the drilling machine, so you couldn't go backwards with it. And of course we're getting closer and closer. The English and the French are getting closer and closer together, and the whole intention is that they should meet It wasn't so that they just passed each other underneath the water. The idea was that they should meet. So I don't know how we did this. We persuaded the French that they should go there so that our drilling machine could go straight through and come out in France, and then we put it on a ship and brought it back to England, and the French machine is still there. Plant specifically bought for the purpose of the contract. Why the French agreed to it, I don't know. But the other interesting thing is, and I believe this is true, it may not be, it may be some fairy story. Why did the French not simply do that? Or even go back and come this way and go back to France again? I don't know. But that apparently is what happened. And I have no reason to disbelieve it. You might put it into Google and see if I'm telling the truth. So far as I'm aware, I am telling the truth, but it may not be. It may be a fairy story. Okay, contract costs, such costs specifically chargeable to the customer. Recognition of revenue and costs should be done according to the stage reached. And stage reach causes us a little bit of a problem, not much. The stage reach is typically determined by an architect or a construction engineer or a person's skill, maybe even the directors themselves. And they will look at a job, a contract, work in progress, and they'll say, I think that's about 58% complete. How on earth did they do that? I think it's about 58% complete. So they just look at the job and, no, maybe it's only 57. Come on. How do you determine between 57 and 58% complete? But skilled people apparently can do this. So the revenue recognition is normally based, and will be based, on the extent of the stage reached. And similarly, costs will be allocated on the same basis. So I know what my overall estimated costs were at the start of the contract. But on a regular and continuous review system, I will know at any time what my costs to date have been, and I will also have an estimate of the costs to complete. So when I'm doing my cost recognition, I've shown you how we're going to calculate revenue recognition. Revenue recognition is going to be the percentage multiplied by the contract value. Cost recognition well, actually it splits down into two elements. It splits down into two. First of all, period specific. If we have incurred any costs which are specifically related to this accounting period, then we will recognize 100% of them. If it relates only to this accounting period, maybe there's some correction work necessary, maybe the architect has said that won't do, you'll need to tear that wall down and rebuild it, that will be a period specific. It's not a part of the general contract costs. So if it's a period specific cost, then we're going to recognize 100%. But otherwise, if it's just general contract costs, it's part of the original estimate, then we'll take the same appropriate percentage. We'll take this percentage multiplied by costs to date plus estimated costs to complete. All this information will be given to you. The costs incurred to date plus the estimated cost to complete. And that's the calculation of the cost recognition. Now, if I'm recognizing revenue, and I've got this calculation of costs appropriate to allocate against that revenue, then that's going to give me profit recognition. My revenue figure will increase within the financial statements. My cost of sales will increase by this calculated figure, and that will automatically then increase my profits. Can you see that it's perfectly possible, Lena, it's perfectly possible that the costs, period specific plus the general costs, could exceed the revenue recognition. If we've got a major period specific cost, or if our estimate has now had to be revised because we're being charged more for raw materials, can you see that that figure in brackets there could be greater than the revenue to be recognised, could be greater than the contract value? In this situation, listen, because you will miss it. In the situation where a loss is forecast, then the loss is recognised, that bottom X, the loss is recognised in full in the year that you recognise that a loss is to be made, a loss is going to be suffered on the contract as a whole. You predict what the total loss overall is going to be, and that then becomes this figure. Revenue recognition will be calculated in the normal way. But instead of deducting costs from revenue to give us profit, if this is projected to be a loss, then that's the next figure to put in, and that one becomes the balancing figure. If you're predicting a loss, put the loss in the bottom line, and then the second X becomes whatever figure is necessary to make that addition add up. If the loss is forecast, recognize the loss in full as soon as you forecasted it. It's down at the bottom of page 71. It's the last few words on page 71. The accounting treatment recognises revenue the appropriate percentage, which always will apply. Recognises expense the same percentage of total costs unless a loss is forecast, in which case we recognise the forecast loss in full, and then the costs become the balancing figure. And finally, no profit is recognised until contract is sufficiently advanced to be able to predict with reasonable certainty the ultimate outcome.